You want to become a homeowner before the end of 2026? If so, here's some things you should be doing right now. A lot of people wait until they find the perfect home before they start applying to buy. That's one of the largest mistakes that a future homeowner can make, and one of the most common. If your goal is to become a homeowner before the end of 2026, the best thing you can do is start preparing now, even if you think you're not ready yet. Here are some important first steps to start. First thing, check your credit early. Don't assume that, oh, my score is high enough, or it's not good enough, or my scores are 700, I won't have any issues. Your score affects more than just how much you can afford or whether you get approved. It affects your interest rate, your monthly payment, your loan approval options, and your ability to get down payment assistance if you need it. Don't wait until you're under contract to discover issues on your credit report. Just because you have a good credit score doesn't mean that you don't have other issues. You may have a charge off. Yes, maybe that charge off or collection doesn't drop your score below the needed value, but it may be in a time frame that's not makes you ineligible for loan approval. Don't open new credit cards or finance new furniture or buy a car while you're getting ready to buy to get set up for your mortgage. A lot of people like, oh, we make enough income. My wife and I are going on the loan, or I know we can afford a lot more, so we're going to go get this car. It not just affects your debt to income ratio, it can also affect your credit score. Usually when you take on a new installment loan, your score can drop anywhere from 20 to 30 points. So that's something to look at. Start saving your bank statements. You want to have the lenders, we always review your bank statements. We need at least the last 2 months of your bank statements, your payroll deposits. They want to see your savings patterns and your large deposits. So if you're getting large deposits, if you have some other job or you sold something, you need to have documentation so that we'll be able to get that information and get that cleared, especially if it's within 60 days of closing. Your savings patterns, and not just your savings patterns. Do you have NSFs on your account? Like, yes, you make a lot of money, but maybe at the end of the month, you have a couple of NSFs or overdrafts, even though they're being paid by another account. That's an issue with underwriters. So you want to make sure that you don't have any of that going on. Keeping your finances clean right now, especially the first 3 to 4 months before you actually apply for the mortgage and close on your home, can prevent underwriting headaches later. That's why you want to look at those now so you can clean them up if you have those things. You want to avoid unexplained cash deposits. Basically, unexplained cash deposits or anything that don't come from any documentable income, like your any type of your job. If you transferred money from other accounts, child support, alimony, palimony, disability. If it's just random cash deposits, and especially if they're over a certain amount in your bank statement, that will cause issues with underwriting. Don't change jobs, before while you're getting ready to purchase a home. Just say, hey, I've been on this job, but this job I'm making more money. Yes, your base salary may be making more money, but you could have been making more in overtime and bonus on the old job. And now that you started the new job, you can't count that overtime and bonus because you haven't been on that job for a year or 2 years to do that. Changing the pay structure also changes it. You may be making more money, but your pay structure may be more bonus incentivized or overtime incentivized, and the other one you had more steady income that was documentable. So that could complicate your approval. You need to also calculate what you're comfortable paying monthly. Don't just go in looking at the price of the home or the neighborhood. You also want to say, hey, I can afford 600,000, but do I want a payment that's 600,000? Do I want a $5,000 a month payment or $4,800 a month payment? Maybe we want to stay at $3,000 a month or $2,500 a month. You need to be already pre-approved so you can equivalate what the house that you want with that payment, or the payment that you feel comfortable in with the house that you want. You may feel comfortable with a certain payment, but like can't find anything that you want to live in or a neighborhood that you want to live in, and may need to do some things with your credit or your income or restructure so that you could afford, more of a home or a better neighborhood or anything like that. Don't shop basically just on price. You want to also look at the neighborhood. You want to look at the loan program. Everything you look at is going to be, yes, your payment. So you want to look at the price, but you also want to look at your payment. Some people are like, oh, I don't want to live in anything less than $300,000, but then they don't want the payment for a $300,000 home. That's what I see every day. Or oh, I wish I could afford more, but they don't want to afford more in the payment. It doesn't work like that in anything that you purchase. So you want to focus more on your monthly payment comfort. You want to look at taxes. You could a home that's $300,000 in one area may not be the same price as a $300,000 home in another area because the taxes may be more expensive in that county or that area. You also want to look at your homeowner's insurance. Certain areas, certain homes may have a higher homeowner insurance, or if you're somebody you've had a lot of rental claims, your homeowner's insurance may be higher than the average person's monthly homeowner's insurance. HOA dues, just because you can afford a $400,000 home doesn't mean that you can afford a $400,000 condo. $400,000 home may have a HOA of $100 a month. $400,000 condo may have a HOA of $450 to $650 a month. So you can't necessarily afford the same price depending on the property that you're looking at. And utilities, that's something that you look at. We don't calculate it. A lot of times in VA or residual income, we'll look at it, but the utility bills. So if you look at that, like, okay, yeah, our mortgage payment is $3,000 a month, but you also have another $600 worth a month of utilities. That's something that you and whoever you're purchasing a home with definitely want to go over and make sure you're comfortable with. Another big thing is start building your down payment and closing costs. So there's down payment assistance programs out there, but you also still need your closing cost. Not all sellers want to contribute to your closing cost, and if you do need someone to contribute to your closing costs, you definitely want to start searching now, get pre-approved, and get with an agent that understands your financial situation. Some agents aren't great with helping people get closing costs. They just like, hey, that's their personal deal. I'm work more on the price. You and your agent need to be, and your loan officer all need to be on the same page so that we can get you the best deal possible for your situation. Outside of your closing costs, you'll need earnest money. Earnest money is how you actually, solidify a contract. A seller's not going to take their house off the market without getting earnest money. Earnest money is usually 0.5% to 1% of the purchase price. So if you're looking at a $300,000 home, they're going to usually ask for $1,500 to $3,000 worth of earnest money. That does go towards your down payment and closing costs, but you have to have that up front. Then right after that, you're going to have a home inspection and an appraisal. All these things do need to be paid up front, and you haven't even closed yet. So you want to have that money up front so that when you see a home that you like, you can pull the trigger and get everything going. Then you have your closing costs. Your closing costs, you like to have them already up front, but you do have time while you're on the contract to build that up or to get that negotiated. But you want to have an idea of what those closing costs are going to be. And then outside of your down payment and closing costs, depending on your loan approval, you may be required to have reserves. Or if you're someone and you own multiple homes and you're just looking to buy a new home, you have to have reserves, not just for that home that you're about to buy, maybe two to 3 months. You may have to have 2 to 3 months for the other home that you have in another state, or that's a rental property or something like that. So the earlier you prepare, the more options you'll have, the more obstacles you'll be able to overcome before it's crunch time. Many buyers have no idea what they may qualify for. You may think, oh, I can do a conventional loan, or you actually only qualify for an FHA loan, or you may think you only qualify for FHA and you could qualify for a conventional. Veterans, you want to make sure that you have all your VA benefits and everything's good. Another issue that people run into on VA loans and FHA loans, you have to have a clear CAVERS. CAVERS is basically as simple as you don't owe the federal government any debt. You don't owe them any money, and if you do, it can keep you from getting a mortgage, whether that's FHA or VA loan, and USDA. Conventional loans, you're definitely going to usually have going to have some reserves. You also want to see the benefits for you going conventional versus FHA. Depending on your credit score, you may still qualify for conventional, but you may have lower mortgage insurance on an FHA loan than you would have on a conventional loan based on your credit score. Again, also your down payment assistance programs. If you want to get a down payment assistance program, you want to apply early, see which ones you qualify for. It's not just about the type of loan. You have different down payment assistance programs that are available per area, per city, per county, per employment, what you do for a living. If you're a teacher, educator, a protector, different things like that. You may also want to check with your job. A lot of companies have some type of money or grant that they give their employees after they've been there for a certain while that they can apply for, and that can help you with some of your closing costs. So talk to a mortgage professional, preferably me, before you start shopping, and we'll build a plan to improve your approval rate, to increase your buying power, and to avoid common mistakes. Create a timeline to purchase before the year end. That way you know and you're ready to write a contract when you actually see something that you like. If you got any questions, you can schedule a call with me. Reach me at 404-461-3172 or apply at reggieloans.com. Talk to you soon.